All right. Good morning, good day, good night, depending where you are. Thank you for attending our BioVerse episode number 14, the current global trends of biotech IPOs. Today is my great pleasure to have such a prestigious panel of speakers and experts in this very interesting corner of the biotech market. And if you are dialing in BioVerse for the first time, let me introduce a little bit ourselves to you, and also later I will let the speakers introduce themselves. So I will do a quick share of slides. Please give me a thumbs up if you can see that. I'll be really appreciative of that. Okay, so you can see my screen now. All right, so this is so Laura, can you see my screen, please?
I cannot see it.
You cannot see it? Okay, let me try one more time. There's always a little bit technical problem. That's normal. How about now?
Yeah, I can see it, Leon.
Perfect. All right, perfect. Thank you, guys. We'll do this together. All right, let's do one more time. For those who dial in the BioVerse for the first time, this is our flagship event organized by 3 US-based nonprofit. So this is who we are. The first one is ourselves, iSweet Community. We are a US-based nonprofit. Actually, most of our members in the States, and our physical address is in New Jersey. And our second organizer is SAPA, Great Philly chapter. SAPA, the full name is Sino-America Pharmaceutical Professionals Association. And in this case, we are working with the Great Philly chapter. The last but definitely not the least, the BioSpark group, which is a biotech-focused nonprofit with a lot of their members in the Massachusetts area, but also with other members around the world. So simply speaking, all of us, our US-based nonprofit really serve a lot of Asian or Chinese ethnic professionals in either biotech or biopharmaceutical industry. That being said, let's just move to why we are here today. It's my great pleasure today to have such a distinct and experienced panel of speakers. And on top of that, we're also very, very grateful for the sponsor today, which is Wells Fargo Private Bank. Thank you very much for sponsoring today's webinar. And we hope more sponsors will be step forward, help us to generate more impactful webinar in the future. That being said, let me invite the speakers, probably on the screen from the left to right, to introduce yourself. So Andrew, how about you get started?
Thanks, Leon. I'm Andrew Lam. I lead biopharma private equity at Ally Bridge. We are US-based private equity venture capital firm. Within biotech, we mainly invest in crossover names, so companies that are last private round before the IPO. I've been with Ally Bridge since 2021. We are originated from Hong Kong, so we have a global perspective as it relates to investments within the space.
And thank you. My name's Daniel Parisotto. I'm a managing director on the healthcare banking team at Oppenheimer. Oppenheimer is a global service investment bank. We do everything in the biotech space, from private placements to IPOs and M&As and everything in between. Came to the firm by way of Regeneron Pharmaceuticals, where I did strategy analysis, and before that I was on the equity research team at Guggenheim Partners.
Hello, this is Enna Weng. I am a managing director at Freedom Capital Markets. I'm head of investment banking, as well as director of our family office. Our family office is sector agnostic, but we do look into healthcare deals that's grow late stage with a near sight into an exit. ideally 12 to 24 months. And from the investment banking side, we look into all sectors. But healthcare plays a very impactful role on our deal flows, probably compose about 70% of our deal flows in the healthcare sector.
Hi,
Alex.
Yeah, sure. Hi, this is Alex Yuen. I'm Managing Director at Jefferies. I head up the North Asia ECM department based out in Hong Kong. Probably the only Asia-based person speaking in this panel for today. So I have been an investment banker for the past 20 years, primarily focused on ECM, raising capital for investors. I've been with Jefferies for around pretty close to 6 years. Before Jefferies, I was with UBS and also JP Morgan for around 15 years before joining here. So very glad to be here, to be able to speak here on this panel.
Great. Hi, everyone. My name's Peter Devlin. I am a securities lawyer at the global law firm Jones Day. In my practice, I work on a full range of capital markets transactions, but with a particular focus on international companies and life sciences companies and sort of accessing US capital markets.
Fantastic. Thank you very much for the kind introduction. Now let me stop sharing the screen. And actually, before we get into the questions, we really spent a lot of time to discuss before the webinar. I also want to give a kind of a heads up to all the attendees in the audience. During the presentation, and if you have any questions, please only use the Q&A button in the lower middle of your screen, and we're gonna check those questions and select those are relevant to us and to the broader audience. By the end of the presentation, we kind of want to group all the questions together. With that being said, let's dive in to this very exciting topic. And so the first question is, what factors could drive the company choose one listing value over the other for IPOs? For example, there's people think about compare US versus Hong Kong versus probably Shanghai, or like some European companies that think about either some of the European markets versus US or some other places. So before we get into this, actually, I know Enna sent us some very nice slides with that. I would like probably Enna, you start with a little bit introduction of the slides you made, and you can probably set a little bit stage of what we should expect. So give me 1 second, let me load the slides, and again, give me a thumb up if you can say that, and I will drive the slides, and please let me know if you want me to move to the next.
Yeah, sure. Yep.
All right.
Perfect. So we kind of like took a deeper look into the data, and I wanted to make sure that this is a reflection of September 30th number. So if you're looking into market returns post Chinese monetary policies, the whole entire package that released the past week and a half, it might not reflect the total return, but should be sufficient. So because the first day of the monetary policy from China was around September 24th, if I remember. So you can go to the next slide. So here is an overview of the IPO by the region. So US, which is NYSE and NASDAQ. China is Shanghai, Shenzhen, and Hong Kong Stock Exchange. Euro, we're looking at the London Stock Exchange and Euronext, which is the major ones. And obviously, we might skip some of the European ones, but it's pretty much an overview on how you can see high level. US was in the peak in 2022 and 2021. China was peaked up the last three years and then kind of like trend down 2023 and 2024. 2024 is pretty much, very low volume, and versus in Europe, there's pretty much nothing. In terms of return, as you can see, 2020 and 2021 is the peak, and China was still peaking up in 2022, and pretty much everyone trend down the last 2 years. and it can kind of like break into pre-pandemic, pandemic, and post-pandemic. Volume significantly came down in China just because, you know, geopolitics between US and China, as well as most institutional investors are kind of like staying on the sideline and not really putting capital into that region most recently. You can go to the next slide. And this one is, you know, kind of like break this into a subsector within healthcare, you know, from biopharma and healthcare services, equipment, tools, and providers, and break it down. And you can see in the US, biotech is still considered the majority on the pie chart, versus China is a blend of, you know, pharma and biotech and a bunch of other stuff. And Europe is, because European is not, we don't have a lot of deals listed in Europe, so pretty much self-explanatory. And I want to make sure to make a point, this is only return, the bottom section, this is only return talk about 2024 year to date. So the number of the return, the data is September 25th. So this is not an latest October number, but you can kind of like, you know, see an overview on how the sectors have been performing. And in healthcare overall is kind of like trended down so far, but, you know, we should see a rebound, hopefully post JP Morgan in 2025. You can go to the next sector, next slide, sorry. And here we're looking, we wanted to break this down by, you know, the market cap, right? Because when you're looking into healthcare IPOs, majority of the healthcare IPOs are not in the billions. They're probably more towards under 1 billion in the small cap and micro cap space. And you can see the return kind of reflect that. And in the US, a lot of these returns are kind of trending down if you are not in the right market cap in terms of current return. Most of the stocks have a pop on day one return, or usually maybe within the first 30 days up to 180-day lockup period. You know, it's fine, but if you're looking into longer term, the higher value it is, you know, when you trend into the large cap space, then usually trade up. That's just the nature of the business. And the return in China obviously is significantly, you know, lower comparing to the US in some ways, and European is pretty much trend down for the most part. Next one. And this is just like overview. We look back into a 5 years on the different exchanges. So we're comparing this with the S&P 500 healthcare, the MSCI in Europe, as well as China, as well as Hang Seng in healthcare. So breaking down in healthcare, which you can see that the S&P 500 and the S&P healthcare is, you know, obviously having a better return at the moment, and all the other ones are returning, but probably not as performing as well as the US. Just to reflect, the US economy is kind of like, you know, picking back up. You know, we're not talking about like a hard landing, soft landing, or even no landing. And versus the other, you know, the other region of the world are still kind of picking up. European is still okay. And China, when we're looking into the stock market the past week and a half, it picked up 25%, but kind of like trade down again the last 2 days. You know, for the most part, it's because there's not enough physical policy coming out of the government to reflect the monetary policy, which helps the stock market, but doesn't really help the, you know, the fundamental and infrastructure. At least from the institutional investor perspective, many of the US investors are still staying on the sideline. So the next one, if we still have a next one. Yeah, and that's it. So just to overview, that goes back to kind of like demonstrate many of the healthcare are, at least from my perspective, many of the healthcare are still looking into an IPO into the US market. The Hong Kong exchanges is not getting a lot of traction right now because it hasn't been performing that well. It's quite a disappointed, you know, for a lot of really good life science companies locally. So many are, you know, kind of like looking into the US IPO. So I'll pause there and maybe let other bankers to chime in.
Yeah, fantastic. So probably before, of course, everyone please chime in. Before that, I really want to cue Daniel because I know you published 2 reports yesterday, and I read them. Quite interesting. Could you, given what Enna just described, the overall global about kind of a capital market, what would you say, of your highlights from your 2 recent reports, which are third quarter updates of capital market, both private and public, and IMI?
So maybe I start on the private side. It's been quite a remarkable year for private biotech companies. It's looking to be by the end of the year probably a year that's better than a 2020, almost scratching on the surface of a 2021. But the issue is that there is fewer deals, but deal sizes have increased. So 2/3 of the activity on the private side is driven by mega rounds, $100 million plus deals, also quite a few $200 million plus deals. And so it's a tale of 2 cities on the private side, really. There's those companies with established management teams with a track record of success and in the clinic already with some clinical data in hand for the most part that have an easier time raising money than their preclinical counterparts. But there's a lot of dry powder available on the buy side. The last few years have been quite successful for a lot of funds on the M&A side, in particular for private biotech companies. And these VC investors recycle that cash back into the sector. And LPs are also not running away from the biotech sector. There have been a number of funds that have raised large new vehicles over the last 10 months of this year.
All right, fantastic. Anyone have other comments?
Yeah,
I think I just want to supplement or add one sort of data point in terms of the Hong Kong capital markets. Echoing Enna's earlier comment, indeed, we're seeing a lot of Chinese companies currently trying different ways, right, to basically tap the US market either via a separate sort of new listing or setting up a new sort of structure to have new investors coming in to be the anchor investors before tapping the US market for an IPO, or potentially for some of the Hong Kong listed Chapter 18A companies trying to do a dual listing in the US, for example. I think Ascentage is currently doing their dual listing attempt in the US. But I think for some of the modalities which you can find some relevant trading comps, which is still trading pretty okay from a valuation and liquidity perspective in Hong Kong, we're still seeing some Chinese companies trying to tap the Hong Kong market, for example, in the ADC space, while we're still seeing the likes of Kelun Biotech and to a lesser extent, WuXi, for example. Both of them actually traded pretty well in the aftermarket from a valuation perspective, and that's why we continue to see some similar companies in the ADCs category. For example, the BioKin of the world, which is already listed in Asia, currently trying to do a dual list in Hong Kong, and also another company called Duality Bio, who is also looking to tap the Hong Kong capital market. So while there are, I would say there will be over, call it 80% of the companies in China currently eyeing for US market, there are selective companies in some highly sought after sub-vertical within biotech, which is who is also still exploring the Hong Kong capital markets.
I'll just add from an investor standpoint, to Daniel's points, this year we're up about 100% on IPOs versus last year, but I think we're still significantly below the 10-year median of around 35 to 40 in the US. So we're way down from the median, 10-year median, and way down from the 2020, 2021 bubble in US IPOs. I think this is a survival of the fittest, right? There are folks that are going public are the ones that are and trading well after they go public, have stayed on the sideline and matured and executed for the past 2 years while the markets were closed, the past 3 years really. So I think these batches of companies that are coming out are really the strongest of the group. Great story, great management team, the right capital structure in terms of investors, and thematically in the right spaces. A lot of obesity companies, I think to Alex, in the Hong Kong market, ADCs are thematically a very attractive area for big pharma strategics and even for investors. We led the Series B for Profound Bio, so we are intimately close to that space, and like many investors, love clinical data. So I do think that it is a bifurcation of haves and have-nots. If you have great data, great management team, great syndicates, you do have options to go public.
And I would just add to that, Andrew. I mean, I think it really emphasizes the importance of the timing from a disclosure perspective, right? Because beyond the IPO, I think you saw a lot of companies that IPO'd in 2020 and 2021 when valuations were really high, got out there. And unless you have kind of strategically thought through, catalysts to maintain the equity story, really deliver on something, I think a lot of those companies are now having a harder time in the follow-on market raising additional capital. So I think, companies are coming into the market, in our experience, a little bit later on when there's a better visibility and a better pipeline on when their data catalysts are going to hit, so that they can maintain that enthusiasm in the market beyond the IPO.
Fantastic point. I think that's set a really good stage to get started. My take-home message is like the US is doing great, but of course it's like just Daniel said, this is kind of a two-sided story, right? There's haves and have-nots, and the bifurcation is getting wider, not smaller, unfortunately. So now let's get into the second question. We talk about IPO, but there's different way. There's a lot of granularity. And for example, what are the common types of listing vehicle? I mean, actually, there's actually one question from the audience already. They want us to comment a little bit about the SPAC, just one example. And also other type of listing in about the industry. What factors actually really help people or kind of nudge people to choose different vehicle or format to get listed in different markets? So anyone want to get started?
I know we have the IPO versus M&A discussion, in 2 questions away, but in terms of the SPAC, now the SPAC versus M&A, the problem with the SPAC is you need to raise a pipe, and really depends on how that pipe looks like, and what the sponsor looks like on the SPAC. Most of the SPAC hasn't really traded well. We actually looked into the SPAC the last 2 years in the US market, and this is sector agnostic and not just limited to healthcare. And majority of them traded down 60+%. So that's a reflection on how SPAC perform, which is probably not ideal. Some of the healthcare company, when you do need capital, majority of time a reverse merger turn out to be a little bit better option, because some of the shell company actually have cash on the balance sheet. So just some view on that.
I think from a legal perspective, I think the thing that drove a lot of companies to think about SPACs and reverse mergers historically has been kind of an expectation that they'd be a faster and a cheaper route to becoming public. But I do think that one thing that maybe has caught some folks by surprise is the SEC in the US has gotten a bit skeptical of these structures and has really tightened up the regulatory regime. And so I think on the SPAC side, when you go through a SPAC, de-SPAC process with the SEC, the number of comments from the SEC and rounds of review have increased substantially. And so I think, in terms of cost and speed, they've probably, equalized a little bit more towards a traditional IPO. I think they obviously, because they're a merger rather than a market-based, IPO, there's maybe a little more execution certainty, a little less exposure to the market. But I think in terms of, time and cost, people probably should start thinking about those as pretty similar, I think, in terms of a traditional IPO.
Yeah, I do agree. I think from Jefferies' perspective, given the fact that we have been very active all the way back in 2021 in terms of helping a lot of the biotech specialists in the US to raise a SPAC IPO for them, and subsequently trying to identify targets for them to do the SPAC and then the subsequent pipe offerings. We do see that there has been a abrupt change in terms of the overall sentiment towards this particular listing vehicle, right? Back in 2021 versus the current stage, right? I think one example which we can probably point to is the Comron case, right? The Helix acquisition corp, right? Which I think they've got the Moonlake being injected and doing the de-SPAC. I think a lot of things. I mean that one actually went pretty well, but I would just say that it needs to actually check a lot of the boxes, right? You need to have a really high-profile and capable sponsor. Comron being one, obviously the Isla Bridge in the core is definitely in that same category. But I think if you look at the Moonlake asset, right? I think at the same time, there's another company called Accelerant, which is starting with a sort of the similar indication or category. For that particular situation, I think Accelerant's program is actually not doing quite well, and this can actually create a lot of good opportunities for the investors to look at Moonlake, right, and to trade and hold that particular vehicle for the longer term. So I would just say that for a successful SPAC offering to work, I think it does need to check a lot of boxes, especially given the overall pipe situation for these SPAC deals in the US. I mean, for the ones that we're seeing right now, most of them are actually quite struggling to find a good lineup of pipe investors.
I would say if you put it together, I mean, it's really the same process, right? Either you're raising a pipe for your SPAC, you're raising a crossover into the IPO. You're effectively trying to de-risk your subsequent financing by stacking your in a prior round with investors that have demonstrated their ability to support that round. So with SPACs, the issue is you have very high redemptions up to 90+%. So even though it's supposed to be a bucket of money looking for a business plan, that money it's not really guaranteed to be there when their SPAC is consummated. So hence you're relying on there's pipe to really take on that responsibility of providing that cash to the company.
And
Fantastic.
I think that,
So, go ahead, please, Daniel.
yeah, just briefly, I think the gold standard certainly is an IPO. And if a company can't do an IPO, reverse merger is an option. And then doing a SPAC is a third option, but that's just not doable in a market like this. And I think for reverse mergers, they've become quite competitive as well, especially for the shells out there that have still plenty of cash on the balance sheet.
Great. So my kind of a quick summary is IPO number 1, reverse merger number 2, SPAC number 3. In terms of the rigor or the kind of acceptance among the investor, that's kind of a fair, quick summary of the 3 major vehicles for now. Or anyone think this actually have a more details I missed? Okay, so I take the silence as agreement. So we can move on to the third question. now let's really focus on, Enna already mentioned a little bit. She mentioned, there's a kind of a competitive a competition from the M&A front. So let's do everything together. And so the third question is like, if you compare IPO versus M&A, and another very important one, licensing dynamics, including new co-formation. So there seems to be a trend among the biotech companies by try both IPO and M&A and at the same time dual track. That's number one. And what's the position underlying this different kind of reasons when they decide between IPO and the M&A? Of course, during our discussion, quite a few of you also mentioned that another option is really about our licensing, especially for the companies based in Asia, or even like a new company formation, which Bloomberg just reported this morning from a really interesting article. So I kind of threw a bunch of things to you guys. So in addition to IPO, there's M&A, there's our license and the new company formation. What's your view? What do you think? What do you have seen when you talk to your clients around the world?
I guess the main reason is really to create competitive tension by running a dual track process. And basically the message to big pharma is buy us now at a cheaper valuation or at a later time point with a more expensive price sticker. And my view on this dual track option is that it's great, but it can also backfire. While the M&A process is, of course, confidential, it's leaky, and investors usually know if there's no success or big pharma interest. And now if a company like that ends up IPOing, that puts some pressure on the aftermarket performance because everybody knows there's no immediate M&A thesis. And perhaps there is one again, and half a year or 2 years after the IPO with additional clinical data in hand. And I think there's certainly one truism for M&A, and that is that biotech companies are not being sold, they are getting bought. So sticking your neck out without having at least one serious interested party around the table can backfire in my opinion. And a licensing deal just takes a very long time. M&A deals can come together much faster. And on occasion, though, licensing conversations can transform into M&A discussions, but it's more the exception than the rule. And obviously, for Asian companies, it's a great way to monetize assets by licensing them out to European investors.
I'll just chime in here. I think in a time when the markets globally, US is improving, as we have discussed. Asia is challenging. I think licensing is a needed lifeline for many of these private biotech companies out of China, out of Asia, even in the US. When the capital market, when your story is not fully baked yet, because either you're a platform company with a number of assets that need to be advanced. Money is tight these days. I think there's much more motivation by companies to transact, to provide some quote unquote non-dilutive funding. So I do see it as an avenue for financing, given the traditional equity financings are limited.
And I think maybe just one thing to add is, I think as people kind of think about, it's great in theory to have optionality to do sort of everything everywhere all at once. There is a downside, right, that folks need to keep in mind of, each one of these processes is itself time consuming, expensive, involved. And so for depending especially for a smaller company, the process of undertaking, a dual or triple or multi-pronged approach, you're going to involve a significant drain on your management team and where they're getting pulled in a lot of directions. And obviously, advisor costs are going to add up quickly. So, I think it makes sense for companies in some circumstances to pursue multi-path approaches, but it does need to be, I think, a strategic decision that's really thought through up front where you're going to go.
Yeah, I think I also want to chip in a little bit about the new co trend that we've been seeing. I think if we look at the 5 or 6 new co being set up so far, I think 5 of them are actually involving a Chinese company. So I think this is actually as a result or a function of the fact that right now a lot of people are actually very concerned to invest specifically into a company with a Chinese element, right? And that's why we have seen so many companies trying to form a new co, inviting, as I've said earlier, right, inviting new investors from the US to potentially come in and anchor and be the largest shareholder of this new co, right? And then to raise fund on a standalone basis, while having the original parent or promoter just coming in as a sort of a minority shareholder, potentially taking a chairman seat. But in terms of the overall execution and management of the company operating, the keys of C-suite management operating the company, most of the time, these new investors or new shareholders, institutional shareholders from the US, they will have the liberty to engage and or hire a sort of a US person, right, to run the business. So I think all these are really trying to circumvent a few things. So one is we try to, some of these companies try to delineate from the China element, right? So that when they are trying to raise a new round of capital, investors would not be too concerned into investing into a Chinese company. And I think also second of all is kind of the valuation resets, right? If you look at some of the Chinese companies, Chinese biotech companies who have been successful in raising multiple private rounds before 2021, they started to feel the difficulty for raising more at an even higher valuation. So in this broader dynamics, if there's a chance for them to spin out one or two lead assets to form a new company, this is actually a good chance or good way for them to have a new platform and to let the new investors to come in to assign a new valuation for these one or two lead asset in a new platform. Right? So I think this is one of the fundamental or underlying rationale as to why we are seeing so many new companies or new co being set up in the past 6 to 12 months. I think another a trend that we're seeing is by talking to some of the China-based big pharma guys, biopharma guys, the likes of CSPC, Sino Biopharm, Hengrui, right, etc. I mean, these guys, 5 years of operations, apart from the fact that they have already been doing a lot of commercialization of the existing drug, they do have a lot of resources internally to develop, self-develop their own in-house early stage biotech products, right? And for some of these products, usually is quite sort of well received by US market. But for a typical biotech IPO or biotech company to work in the US, I mean, the US market doesn't really tend to look into 10 or 20 types of assets, right? They will only have time and resources to focus on one or two. And that's why when talking to these big pharma guys from China, they also have a tendency to try to spin out one or two of the top lead asset, which is presumably very well received in the US market, right? For them to set up new company to raise capital on a standalone basis. So I think those are sort of the two rationale or reason why we're seeing this new code trend being popped up recently.
Yeah, fantastic. I think that's a very good transition to our fourth question. I know Enna, you want to jump in already? And also
I know some. Yeah, I know someone was asking about shell companies, but maybe I'll just point like a couple data points. We looked into shell companies in the last 2 years, since 2022, in terms of reverse mergers. Majority, over 95%, are life science company doing RTOs, and average shell size is between 40 to 60 million. So, you know, considerably very small, like in the microcap space. And usually post-merger in terms of pro forma ownership of the OpCo is 20-80% in average. So that's just some number I'm throwing out there in case someone's thinking about reverse merger. But yeah, that's it.
Fantastic. Before we dive into a little bit Asia-based biotech more, I actually would like to listen to Daniel. So I know you're familiar with the European market a little bit. So What's going on over there? What do you have seen over there?
So on the European side, there really hasn't been a meaningful biotech IPO over the last 2 years. If anything, European listed companies prefer being delisted and exist as private companies. A recent example is Stratex Pharma that delisted in spring earlier this year. But private markets in Europe for biotech companies are more robust than the public markets. And it's really the problem of the MiFID II regulations that went into effect 1 or 2 years prior to the pandemic that really killed the public equity capital markets for small and mid-cap names in Europe. And the goal of most European companies is to do and raise a local Series A and then bring in US crossover investors in a Series B for successful NASDAQ IPO or build the company for potential M&A, exit, or asset sale. And I think certainly there's no shortage of innovation in Europe. It's just that the funding environment, especially on the public side, is more rigid and generally less capital is available.
Wow, that sounds strikingly similar to what's going on in Asia, particularly in China. So I guess Andrew should pay a visit to Europe. Probably you are doing that already. So now I should hand over the moderation to Nora. So please take from me.
Okay, thank you, Liam. So for our next question, let's focus more on Asia-based companies. As we know, many Asia-based biotech companies, in particular those from China and Japan, are very actively involved in out-licensing and merger acquisition, as we just discussed. But what are the prospects for the IPO pipeline? So Alex, you're based in Hong Kong. I'm sure you'll have a lot to say about this question.
Yeah, sure. As a matter of fact, I'm actually right now in Tokyo talking to some of the private biotech companies. So it's actually very timely. I think if we take a look at the overall landscape for Asia, I think we can categorize them in a few different countries. Right? For example, I think we can immediately, I think when it comes to biotech innovation, we can immediately sort of carve out the likes of India and Southeast Asia. I think Southeast Asia primarily is because they're still very focused on healthcare and pharma services, for example, hospitals, right, checkup centers, etc. While India is primarily still a generic and API focused space, right? But I think when it comes to innovation, I think the likes of China, Japan, and to a lesser extent Taiwan and Korea, I think these are probably the 3 or 4 locations which we should be spending more time on. I think first of all, China, definitely a lot of, I mean, on a daily basis, there has been a lot of new companies popping up across all modalities, right? GLP-1, ADC, radiopharma, etc. And especially given that we are actually seeing a huge patent cliff by the end of 2030 in the US. And that's why we're seeing so many US-based biopharma companies trying to tap the China part of the world and make sure that if there's any exciting clinical program coming out of China, they will be immediately try to grab that opportunity, either by way of acquisition or at least forming some sort of a partnership or licensing relationship with these new up-and-coming Chinese biotech companies. But I think when it comes to the overall partnership model that we've seen, I think I would say over 90% of the partnership that we've seen in China are all out-licensing, right? I.e., having companies like Echogene, right, for example, in the GLP-1 space, out-licensing the lead asset to AstraZeneca, right? And then, for example, AlphaGene, right, in the radiopharma space, out-licensing technologies to ArtBio, for example. But I think if we look at some of the listed precedent, right, if a particular Chinese biotech company is capable of developing a particular clinical program, at least to contribute partially, I think co-development, co-deal is definitely a preferred sort of partnership way to go. Right? Just take a look at Legend Biotech. Although I think going all the way back to 2017, I think it actually took the management a really long time to really try to cement a co-development deal with J&J. But fast forward to now, when we see the ultimate sort of sales data on a quality basis, this has actually been fueling the overall outperformance of Legend Biotech's share price in the US market, notwithstanding the fact that the overall sort of US Biosecure Act is still casting some shadow on the overall GenScript Legend Biotech situation. Similar to the BMS SysImmune situation in ADC space, right? And that's why after that humongous co-development deal between the two companies, I think SysImmune also and Biokin, the parent company, is also trying to do a dual listing in Hong Kong. So definitely, in terms of when it comes to the form of partnership mechanism, I think a co-development deal, if possible, I think this is a sort of more preferred way to go. I would say a little bit about Japan, right? I think Japan doesn't really lack any innovation, but I think Japan does have their own legacy issue. If we take a look at the history of Japan, only until a few years back, I think the overall Japanese government is still encouraging the local Japanese biotech companies to achieve positive revenue on a ASAP basis. So that has actually triggered a lot of the biotech companies to just do two things, right? I think one is that they will be focused a lot more on the fee-for-service type of business model, right? Take for example, PeptiDream, right? This is one of the few billion-dollar company which is listed in Japan and be categorized as a biotech company. Why they have become so big, right? Is because of the fact that they started the company from a sort of service-based business model, right, to generate revenue in the very early stage of their development. I think the other end of the spectrum is really the smaller size biotech, smaller size startup biotech companies, where they are being urged, right, by their early VC investors to sell out or to basically out-license their lead asset, even at the phase one or even at the preclinical stage, right, to the big pharma guys, so that they can immediately get the upfront payment and some expected milestone payment down the road, right? But a lot of times, right, these companies, because they're so young, they only have one asset in their company, and if they have already out-licensed that particular lead asset to a big pharma company, either in Japan or the US, there's nothing left in this company, and it's hard for us, right, to raise further capital for these type of smallish biotech startup in Japan. And that's why I think right now what we're trying to do here from a banking perspective is to make sure that while you can still consider to out-license your lead asset to your big pharma, to the other big pharma companies, maybe there's another way for the banks to help you, right, to make sure that for the true innovation that you have created, there could be some external parties outside of the strategic wealth, right? For example, the biotech specialists in Hong Kong, Singapore, US, for example, to give you the necessary funding, right, so that you can become an even bigger biotech company before, right, you consider your next strategic move, right? So this is something that we have tried to facilitate, and as a matter of fact, we have already seen some of the Asia-based biotech specialists trying to tap the Japan biotech market in the private financing rounds. So that's what's happening in Japan. I think I can probably group Taiwan and Korea into one similar category, being that they, in terms of the capital flow, they're actually very localized, right? There are a lot of funds supporting the local biotech efforts, respectively in Taiwan and Korea. Just to give you one example, for example, in Taiwan, right, there's a particular fund called Diamond Bio Fund, which have just done their first IPO in September last year. I think this is actually the first biotech specialist fund doing an IPO in Taiwan. There has actually been a lot of press coverage, and this is actually a pretty highly debated topic within Taiwan as to whether it makes sense for the Taiwan local investors to fund such a biotech specialist, right, into supporting the overall local biotech sector. I think this is one trend that we've seen, right? A lot of local hot money supporting a local biotech. I think the other trend that we've seen, right, is that I think similar to Korea, you have got the likes of Samsung Biologics, right? I think in Taiwan they've also recently established a new sort of a CDMO entity called TBMC, which is similar to the TSMC in the semiconductor space. So basically what the Taiwan government is trying to do, right, is to establish a really sizable CDMO platform for Taiwan, right? So that in the midst of the current US-China dynamics, I think they're trying to attract some of the early stage biotech companies to use them as an alternative solution for CDMO service. Right, and then in the meantime, right, to attract talent, attract some of the real R&D effort into the country or into the region, right, to make sure that they have the opportunity to have a first glance into the real sort of innovation that they cannot otherwise discover, right, locally in Taiwan. So this is also some of the recent trends that we've seen in the Taiwan market. So I'll just stop here. This is basically a snapshot of what we have seen, right, in the Asia part of the world in terms of how the biotech sector has been evolving in the past 1.5 to 2 years.
Yeah, from the investor standpoint, I mean, you mentioned Legend. I think you take a macro view of this. China biotech, specifically China biotech, has matured significantly since Legend, right? I think, I mean, truth be told, when the Legend data came out before the J&J data, before the J&J partnership, there were folks that were skeptical of their overall data set, right? I think their space within China right now, there is less skepticism of the data. There is questions now on reproducibility, which isn't related to data integrity. It's more related to the standard of care being different in China. And hence, if you need to repeat the data in the US or in Europe, will the data repeat? So I think sentiment has improved significantly in terms of the quality of molecules coming out of China. I think additionally, putting China in its own camp, I mean, the reason why there are so many molecules coming out of China is just their sheer number of medicinal chemists, protein biologists within China versus the rest of the world, right? I think that has led to the creation of so many fast followers. I mean, my observation is first in class still often comes from the US, but a year later, you will see 10 or 20 molecules coming out of China, one of which will be best in class. We just don't know. So a very quick iteration coming out of China, which also makes a lot of sense. Like I said, because of their sheer number of scientists that are creating companies and creating and engineering better molecules. I think the challenge with China biotech is indication. It's really chasing after kind of these fast follower strategies and without putting a lot of thought in terms of indication selection. Because if you think about it, even though preclinical development and clinical development is still cheaper in China relative to the rest of the world, it still costs money, right? In 2018, it was a lot of companies had a China-based companies might have a pipeline of 18 to 25 different programs. And they will boast that it is an asset. It is no longer an asset. It is a liability to show a pipeline of 15 programs or 20 programs, right? And the challenge is that, unfortunately, despite big pharma and company creator VCs shopping in China, which is a great sentiment once again, there are too many undifferentiated assets that are being created. Too many molecules that are 50th PD-1 inhibitor. Like I once saw the 50th PD-1 inhibitor being nominated. So it's really moving up the value chain to create greater distinction, differentiation. I think that's needed in order to efficiently attract their interest by investors.
All right, thank you, Andrew and Alex. Anna, do you want to chime in as well? I know you handle a lot of matters in Asia, in particular China and Japan.
Yeah, I do have a slide that we put together, but I'm not going to show here since it's quite a last minute. But the pipeline that the audience wanted to know, there are 9 deals filed in Asia for potential IPO, which is they're all publicly filed at the moment. So obviously this is not including the confidential filing. So that within the 9 deals, there are 3 of them coming out from Singapore. 2 from Singapore, 1 from South Korea, 1 from Taiwan, 1 from Japan, and 1 in India, and the other 2 are from China. Size-wise, they're range between 5 mil to 20 mil, which is tiny. Freedom, we underwrite the India deal that's between 50 to 70 million, which is a little bit bigger. But if you look into the pipeline, there are not that many Asian IPO filed publicly that are in the larger scale, which explain why majority of the bulge brackets or bigger investment bank are not underwriting those deals because size is too small. So if you look into the underwriter on those deals, mainly are micro cap banks. So just want to put it out there.
Okay, thank you, Anna. Great points from everyone. So let's move on to our next question. Our next question will focus on risks. Risks associated with geopolitical tensions and the de-globalization movement, especially for... the question is, what are these risks? How are they impacting the biotech companies, investors, especially those outside of the US? Enna, do you want to take this question as well?
Yeah, I think from our end, it's been quite challenging to attract US investor if it's a pure China deal, unless you hit every single aspect, right? For example, obviously we're talking about like healthcare, but which are majority pre-revenue. But if you are, some of the diagnostic company or healthcare tools or healthcare providers, investors looking into revenue growth, scalability, as well as profitability, right? So those are obviously the key assets. Now, if you are pre-revenue, then your asset needs to be really top of the line. And otherwise, it's quite hard to attract those investors. So we're actually getting a lot of requests, at least, I can only speak from my end, requests in terms of reverse merger. And there aren't that many reverse merger post March 31st CSRC filing rule change from last year. If we look into the data, there's some de-SPAC, but definitely not RTOs. So we kind of like if we were to able to close the deals right now, we will probably be one of the few deals that's post those announcements to do RTOs. And we will have to work with, obviously, PRC councils in terms of filings, because there were some of the deals that went public last year pre-announcement were grandfathered in terms of the CSRC filing rule before F4. So those are the themes that we've been seeing. And then the second part is what Alex touched upon on spinoff. We have a number of these companies that are initially seeking traditional IPO, or there are a couple ones that are already listed in Hong Kong that they, are having a hard time on liquidity in Asia. So they're looking to spin off their US assets and do a crossover round in the US on the US assets, then exit. So those are some of the themes that we've been seeing.
Okay, thank you for sharing your thoughts, Anna. Daniel, I see you have something to say as well. Go ahead, Daniel.
Just briefly, I think besides all the geopolitical tensions around the globe, from Ukraine to Israel and other places, the Biosecure Act still poses a significant overhang in our industry. And remember that the Biosecure Act was already passed in the House earlier this year, and the Senate is likely to pass the legislation with strong bipartisan support later this year or early next year. It's still unclear whether the Senate will take the House version of the bill, but support in the upper chamber appears to be strong. And the likeliest route to enactment here is via the inclusion in a larger must-pass bill. My sense is that this bill is unlikely to be considered by the Senate on a standalone basis, perhaps a spending bill. And in my conversations with US biotech companies, they're all trying to diversify their manufacturing and supply chains away from China, and are basically operating under the premise that the Biosecure Act is going into effect at one point in the future.
Or one
Thank
thing.
you for.
Or what I
Go ahead.
just say, I think that, you know, in light of the risk profile, and I think everyone, you know, recognizes that there's a lot of, you know, global risk right now. You know, I think the key thing for companies thinking about, you know, IPOs or you know, starting any kind of process is just really around timing and planning and giving yourself a lot of time. Like the level of regulatory scrutiny has enhanced. And so I think, you know, what we're seeing is increasingly the companies that are doing IPOs or things are staying in the process much longer than they would have in the past. It's a lot more preparation, and really starting off early in the process to think through all these issues is really the key, I think.
All right, thank you, Pete. Thank you, Daniel. So our next
question. I have
question.
a quick question. Sorry,
Yeah.
a quick question.
Go ahead.
Just based after I listened to all those fantastic sharing, there's one kind of thinking is that the Biosecure Act could have another stronger version, which could block the future licensing deal out of China. What's your view on that? So someone talked about that. Well, how likely that could happen, or that's just like, you know, over worry?
My view as an investor is unlikely to happen. Their targeting of, you know, China-based companies seems to be, you know, anything related to collecting of patient data or any national security issues. You know, I mean, I think if you take it from their other standpoint, they're a Kiso Summit deal. If the U.S. blocks any cross-border licensing, and then their standard of care, their next generation best-in-class molecule is in China, I'm pretty sure Americans will want to have access to that best-in-class drug, right? So hence, I think it is unlikely that it will dampen cross-border licensing and activity.
Yeah, so actually for me, I have another example. I always a little bit struggle to understand why people think this could happen. If you take a Carvykti, for example, right? This is from Legend Biotech. You guys probably recall last week, they have a fantastic overall survival data came out. Looks fantastic, right? Like improved the overall survival dramatically. But a lot of people didn't realize Carvykti was approved in the US more than 2 years before it was approved in China. So this China discovered drug started saving American lives almost 2.5 years before they start doing so in China. Oh, by the way, that drug doesn't sell in China. So, you know, I think, you know, if you really look at the situation like this, not just like, you know, the investor get a return, really, you know, in the end, it's like American life, it save American patient will be helped. So, you know, I'm with you, Andrew, but, you know, I want to listen to other people if I have this different view, you know, we always want to balance out, right?
Well, I think just to add to it, I mean, I think both US and China, the common thing is that they both won national champions, right? I mean, the point about Carvykti, if you have two different drugs of the same mechanism that are comparable in terms of efficacy, safety, then yeah, I agree that there could be, you know, even from a national reimbursement standpoint, China may favor a domestic champion, right? But I think in terms of one that has clear superiority versus another, I don't think it benefits the country to slow roll development of a drug.
Yeah, I think similar to what happened during the COVID times, right? We all try to compare all the vaccine that's available in public, right? I think there has been some sort of market rumor in China saying that why Pfizer's vaccine is not being approved in China earlier, right? Given the efficacy, etc. But I mean, ultimately, right, for best-in-class drug, ultimately, every single government, regardless of whether it's US or China, they will still resort to the most important sort of factor, right? Whether the particular drug is effective, right? If it's best in class, then I think the government is just trying to make sure that their citizens will get that drug, right? Regardless of whether it's being produced in the US or domestically or from China.
All right, great points from everyone. The geopolitical tension and the Biosecurity Act certainly are very hot topics in the industry nowadays, and we will see. So our next question is for our legal expert on capital markets. So Pete, what are some legal considerations biotech companies and investors, in particular those from Asia, should be aware of in the current market environment, especially if they're interested in the US capital market?
Yeah, thanks, Nora. I think it's really what I mentioned in terms of the risk, right? It's really, I think the key is, anticipating that there may be an additional degree of regulatory scrutiny that a foreign company faces. The process may be a little bit more involved. It certainly can be navigated, but I think the key for companies looking to the US market is just starting the process very early, really working with your advisors to plan for these issues, how to address them, starting early, making sure that the story is really well thought through and can be presented in a clear way for both US investors and US regulators, because I think there is an enhanced degree of scrutiny right now.
All right, thank you, Pete. So finally, to conclude our discussion today, we would like each speaker to give some advice to biotech companies, especially those from Asia, on how to prepare for an IPO. Who wants to take a first shot at this question?
Maybe I'll start. In terms of preparation for IPO, I think it depends on where they are, whether they're China or ex-China, because if you're in China, you also have to consider CSRC filing, which will add additional 60 to 70 days in terms of approval time. So company needs to be really thoughtful about their priorities. A lot of times timing is the essence, whether the time is important or not, whether they need cash or not. So if some firms can wait, then conventional IPO might not be might be a better outcome. But if some firms want to rush through certain things, maybe they can consider an RTO/SPAC. So that really depends on what each company needs. And in terms of preparations, I think some of the guest speakers mentioned earlier, if you are almost picture perfect company, you can also consider dual track with a potential M&A in the back end and a filing, working with some bankers on a confidential filing of an IPO. And the ones that we are working on right now are actually doing dual track of a conventional IPO/an RTO. So that's another thing. But at the same time, when people prepare, that means you got to find the right auditor, the right lawyer, who can potentially do IPO as well as M&As. And you probably also need to set aside budget in terms of all the sunk costs that's going to come into either way of an exit, right? Because it's going to be very costly. So, yeah.
And I think a bottleneck for a lot of companies is having audited financials in place. So I think that's always important to point out early on. And just one comment I wanted to make on reverse mergers, because they came up in our discussion quite a bit, is that in the past, companies were very much focused on finding shells with still a lot of cash on the balance sheet. Now that has changed a little bit. The thinking is raise a large pipe, at least $75 to $100 million, if not more, to fund operations to meaningful value inflection points, and basically merge with a cashless shell, right? A shell that maybe only has around $10 million on the balance sheet. And don't forget that a lot of these shells that look great on paper because they still have 75 million or so on the balance sheet. The problem is a lot of these biotech companies have lease obligations and other financial obligations. And so a shell, $75 million on the balance sheet right now may end up having only around $20 or $25 million once a merger is consummated. And raising a concurrent pipe in a reverse merger is crucial no matter what, but it's independent of how much cash the shell has available.
I think advice to companies. I think a lot of companies, when we meet with them, signal that they plan to go public, let's say next year. I think in this market, having good advisors, I'm going to give a shout out to the bankers here. It is very important to have shepherds that will provide you unbiased opinions, whether you can go public or not. Because remember, going public is a financing exercise, right? There's nothing special about going public. Your cost of capital is lower. But I think we're in kind of this environment where we need to be brutally honest about whether you can go public. The company has the right profile to go public or not. I think the other aspect of it is raising money is storytelling. And I think there's not a scarcity of money right now. There's a scarcity of attention. Spending more time to refine your story, particularly within your audience, if they are sophisticated biotech investors, being laser focused in terms of how your programs differentiate versus their other competitors that are out there will yield a lot of dividends, because many investors were often competing against 100 other companies for the same 1 hour time slot.
Andrew, I would just say, I mean, on that point, I mean, I agree, right? So much of the IPO process is just how compelling your story is. And so I think one of the things that I'd recommend companies do is really work with their advisors around, like, either whether it's through the crossover round or if you're doing an IPO through like a testing the waters process, where you're meeting with investors and getting kind of, critical feedback too on how to refine your story before you actually launch, because so much of it is, telling the story in a way that resonates with investors, both at the IPO and then beyond into the secondary market.
Alex, do you want to share something?
No, I think the only thing that's missing, I think our speakers here have already raised a lot of good points. I think one additional point maybe is about for a particular issuer who is looking to do an IPO in the US versus Hong Kong. I think most of the time investors here in Asia versus those in the US, the expectation for a particular biotech IPO to work sometimes might be a little bit different. Right? I think US market is still a market where they will focus a lot on the data, clinical data, whether you're best in class, whether your management is focused on your first one or at most two, right, lead asset that's currently in your pipeline. Versus, I think for a particular biotech company looking to do a Hong Kong IPO, some of the investors here, especially for the Hong Kong-based or even the China-based ones, they're more focused on your likely sort of commercialization strategy, whether you're going to be able to find partner to sell your product successfully in China. Because if you look at a lot of successful Hong Kong listed companies, right, the likes of Innovent, up and coming, right, they're all very focused on commercialization. Obviously, they've got a big value assigned to the GLP-1 program. But going back to the earlier days, right, when we are seeing all the first batch Chapter 18A biotech companies in Hong Kong, all majority of the questions is basically centering around commercialization, how you're going to compete effectively with the sector already being dominated by the likes of Hengrui, Hansoh, Sino Biopharm, where they've got a really strong sales force. They can sell whatever drugs that's on their hand, right? It's not always about best in class. Maybe the first in class is a more valuable sort of investment thesis in this part of the world, in Hong Kong, China. So I think for a particular IPO issuer to consider doing the IPO in different markets, I think they will oftentimes they will need to adjust the overall marketing sort of thesis or investment story when they're talking to different types of investors.
Okay, very practical advice and great points from everyone. And many thanks to our fabulous speakers today. With that, let's turn to our audience and see if they have any questions. Leon, do you want to take it from here?
Yeah, fantastic. So actually, thank you, Enna, and also other speakers. I saw you are busy typing to reply to the questions to the audience, but I do want to give the audience a chance, last 2 or 3 minutes. If you have any questions, please type into the Q&A box, and we will select those relevant to the broader audience to let the panelists answer. I'll pause here for probably 10 seconds. In the meantime, you can pull out your phone, scan the QR code on the left of the screen to learn a bit more about us if you like what we are doing today. InScienceWeTrust community, the nonprofit, which is really kind of started. We started this BioVerse webinar more than 1 year ago. And also, of course, if you have any questions to us, please do email us. And also, the speakers mentioned a lot of really good resources. You can also email us so we can make an introduction to the speakers or connect you to the resources they mentioned today. All right, here actually there's a quick question from the audience from Jimmy Lee. Can the panelists comment quickly on the US versus Hong Kong for IPO? Alex, I guess that's your backyard, right?
Yeah, I think one major differentiation between Hong Kong and US is really about valuation, right? Hong Kong IPO market is always about size, as I've pretty much emphasized in another chat conversation. I think if we try to compare the overall market cap, the average market cap that we're seeing on those Hong Kong listed biotech companies, I would say is in the range of, I mean, at the time of IPO, right, is in the range of, call it 900 to $1.2 billion, this type of range, right? You can seldom find a similar market cap company being listed in the US at IPO. Usually, the average size that we're seeing in the US for a typical phase 1 or phase 2 biotech company maybe is around $300-400 million, right, at IPO. So I think the key differentiation is whether if you want to sort of achieve a sort of premium valuation at IPO, basically pricing your IPO to perfection, right, at the time of IPO, then I think probably Hong Kong is a relatively better choice. But if you care a bit more about your overall trajectory of your company's valuation in longer term, right, then I think setting a more reasonable valuation at IPO and let it trade up on the back of good catalyst milestone, right, and then you do a few catalyst-backed financing after the IPO, with the end game being potentially being taken out by one of the big pharma, and then you move on to a new company. I mean, these are the sort of typical roadmap that we've been seeing in the US, and that's how the US has developed such a healthy ecosystem, right, for the biotech space. I think Hong Kong, I think that's a clear difference in terms of how entrepreneurial in this part of the world in China is treating their own biotech company versus the ones that we're seeing in the US. Right? So I think this is the tradition. It has been what we've experienced. Right? I think if we are really hoping the Hong Kong market to become a little bit more like US, I think it will take at least a decade, from my perspective, right, to transform the overall Hong Kong biotech market for China.
Fantastic. I don't see any more questions from the audience, so I would like to thank all the panelists for the fantastic sharing and insights, and also thank you, Nora, for the moderation. Before I let people go, I also want to do a quick advertisement of our incoming webinar just next month. We're going to talk about M&A, right? We call the ultimate biotech exit. We already talk about today. At least that's the situation in the US. It's where most the investor entrepreneurs get paid out in cash. So we have a fantastic lineup, Niels from the corporate side. Dan, her fund actually, I heard had 7 M&A last year. Li Hua, he just got his company, did a RTO. I learned a word to reverse the takeover early this year. And also Tess Cameron, she's from RE Capital. And RE Capital is kind of one of the cornerstone in terms of influencer in our space. So it's going to be a fantastic panel. So please join us in the next month. With that, before I let everyone go, I also want to make a request and pledge for the audience who are running big company or individual or consulting firm, considering the sponsorship with us. As you can see, we are very impactful, and we reach a broad audience and a relevant audience. And we have 4 fantastic webinars already in our pipeline, including the one I just showed you. So if you have any interest to become sponsored to us, please reach out to us by email. And also, one more time, if you have any question for today's content, also want to ask, make an introduction to the fantastic speakers, please email us as well. And also, you can always scan the QR code to learn more about us. And finally, but definitely not least, we really want people to register our webinar, because the biggest benefit is that you would receive an email with the link of the recording of the webinar very fast. You're going to be the first wave of people to have the recording of the webinar. So if you miss anything because you are cooking or driving, you're gonna see it immediately after our webinar. With that being said, thank you everyone for taking your time, and thank you the audience for attending today's webinar. And with that being said, we hopefully you have a fantastic day, evening, or mid of night. Hopefully it's not the case, and I will see you next time. Bye for now.
Thank you.
Thank you.